Welcome back, guys. It's Money Matters, and I'm Chad Larson. This month is titled Volatility Returns, Oil, Gold, and Staying Disciplined. But before we get into markets this month, I want to start somewhere a little different. Over spring break, my wife and I spent time traveling all across the US, touring college campuses with our daughter. Our son was in tow as well, but my daughter is a senior in high school and looking to make her next step into this big wild world that we live in. And I'll tell you, it was one of the experiences that sneaks up on you a little bit. You go into thinking it's just a trip, and then somewhere between campus tours and long walks and quiet moments in the car, it kind of hit me. This is actually happening now, and we're at that stage. It was a mix of everything: pride, excitement, a little anxiety, definitely some humbling moments. And if you're a parent, you probably know exactly what I mean. You're proud of who your child is becoming, but at the same time, you realize they're about to step into a completely new chapter. And of course, this being spring break, we got the full experience: packed airports, delays, rental cars that may or not been what we booked, hotels that look better online and all in real life, and the full gauntlet. But honestly, it's almost those things that made it more memorable. And through all of that, I'm proud to share our daughter has made her decision. She's going to be attending the Ohio State University and is accepted into the Fisher College of Business. So go Buckeyes. You're going to see me rocking a lot of Ohio State gear going forward. So pretty excited for that. And we couldn't be prouder. And I think it's moments like this that give you a bit of perspective, because we spend a lot of time talking about markets, portfolios, volatility. But at the end of the day, those things are in service of something bigger. And they're in the service of moments like this. And maybe that's a good place to actually start this month's discussion, just because, like in life, markets have a way of shifting quickly. You can go from calm to uncertain to volatile in a very short period of time. And that's exactly what we've seen over the last few weeks. We've been spoiled for the last couple of years of some incredibly strong markets, some incredible positioning. And for segment one, I'm going to talk from calm to chaos and what changed. So if you rewind just a bit, the year started off strong, and 2025 was banner and 2024 was strong. Markets were constructive, there was momentum, sentiment was positive, and investors started leaning into risk. And then almost abruptly, that tone changed. Geopolitical tensions escalated in the Middle East, and there's a war now. Energy markets have reacted immediately, and oil prices have surged. And from there, the ripple effects have started to spread. Equities pulled back, volatility has spiked, and correlations started to shift. And suddenly, what felt like a stable environment became much less predictable. Now, this isn't a crisis. This is not 2008. This is not a systemic breakdown, but it is the repricing of risk. And those moments tend to feel uncomfortable, not because they're rare, but because they interrupt a period of calm. It's like turbulence on a flight. Even if you know it's normal, it still gets your attention, and we're here for that, and I make space for it. I want to talk a little bit about oil, the thread that really connects everything. So let's start pulling on the thread that's driving most of this, and that thread is oil. If you step back and look at everything happening right now, oil is at the center of it. Prices have moved sharply higher, driven by geopolitical tensions, supply concerns, and the uncertainty of how the situation evolves. And when oil moves like this, it doesn't stay isolated. It spreads. It moves through the economy in really real, very true ways. Think about it this way. You fill up your car, it costs more. Companies ship goods, it costs more. Airlines operate, it costs more. Manufacturers produce, it costs more. That increase doesn't disappear, it shows up somewhere. And usually it shows up in two places: higher prices or lower margins, sometimes both. And that's where things start to tighten. Consumers feel it, businesses feel it, and markets feel it. And historically, and this is important, when oil prices stay elevated for a sustained period, they tend to slow economic growth. Not immediately, not overnight, but gradually. It's like friction being introduced to the system, and over time that friction builds, which is why markets are reacting the way they are right now. They're not just reacting to what's happening today, they're trying to price in what this means for tomorrow. So, energy where winning doesn't feel like winning. From a portfolio standpoint, it creates an interesting dynamic because energy has been working. Our positioning has helped. It's been a positive contributor. But here's the nuance, and it's important. This isn't the kind of environment where you step back and say everything is working. It's more complicated than that, because the reason energy is doing well is the same reason other parts of the market are under pressure. So while energy exposure provides a benefit, it doesn't eliminate the broad impact of volatility. And that's why diversification matters, because no single position is meant to carry the entire portfolio. And more importantly, no single position should. So I want to transition a little bit to gold. So, not if oil has been the obvious story this month, gold has been a confusing one. So you've heard me lots over the last months and year talking about oil and gold and metals and materials and resource. But when the playbook doesn't work, because if you were to sketch out, what should happen in an environment like this, gold would be near the top of the list. Higher volatility, geopolitical risk, uncertainty, that's typically a supportive backdrop. And yet we've seen in something very different what we've seen. Gold equities have pulled back. Gold itself is being inconsistent. At times, it's behaved less like a safe haven and more like a risk asset. And when that happens, it forces you to ask, what's really going on here? So, part one is the positioning problem. So, one of the biggest factors, and one that often gets overlooked, is positioning. Earlier this year, gold had strong momentum. Capital flowed in, narratives aligned, it became a consensus trade. And when that happens, trades become crowded. And crowded trades are vulnerable because when something shifts even slightly, there's no one left to buy. And instead of seeing inflows, you start to see outflows. And that's what we've seen. So, the two competing narratives at the same time, gold is being pulled in two directions. On one hand, you have long term structural drivers, central banks increasing gold reserves, countries diversifying away from the US dollar, ongoing fiscal imbalances globally. Those are real forces and they don't change quickly. But on the other hand, you have shorter term pressures, interest rate dynamics, liquidity concerns, and again, positioning. So in the short term, gold can behave unpredictably, even if the long term story is intact. So, what do we do with that? For us, the answer is consistency. We don't chase it higher when it's working, and we don't abandon it when it's not, because our thesis isn't based on what gold does this month. It's based on what gold represents over time, and that hasn't changed. So, I want to talk a little bit. I've been getting a lot of calls around hedging and strategies to reduce volatility, and it's some of it is the illusion of control. So when markets get volatile, the natural instinct is to want to do something, to hedge, to protect, to react. And there are tools for that, and I won't get into all of them. There's options and inverse ETFs and tactical strategies, but here's the challenges. Most of these approaches require incredible precision. You have to get the timing right. You have to know when to put them on and when to take them off. And it's very difficult to do consistently. So instead of trying to outmaneuver volatility, we focus on something that's more durable. We build portfolios that are designed to withstand it. And that means diversification, it means balance, and it means discipline. Because in reality, volatility isn't something you eliminate, it is something that you manage. So I'm going to kind of switch and talk a little bit about copper. Again, a good reminder about time horizons. And copper is a good example of that. It's had a weak month. If you just looked at recent performance, you might question the story. But if you zoomed out, nothing has changed. The demand drivers are there: electrification and energy transition and infrastructure expansion, and supply is still constrained. So what we're seeing right now is short-term movement, not long-term deterioration, and that distinction matters. Now, there are some concerns that Dr. Copper, who is said to have a PhD in economics and really leads the market on that metal that is really linked to global growth. And if we see demand for copper wane, it generally leads into a broader consensus that we're going into recessionary environments. So it doesn't mean these things all can't happen, but we're investing for the long term. So, because if you react to short term noise, you risk missing long term opportunity. So, positioning is to here, guys, is to stay grounded. So, through all of this, what are we doing? We're staying grounded. We're not chasing what's working. We're not just piling money into energy stocks. In fact, talking to some counterparties, one of the misnomers that we're seeing is the difference between the product market and the forward market. Just because oil, we could see a scenario where oil prices spike to 150 to $200 a barrel. That doesn't mean all of the product market is being sold that day. The forward curve of where commodities actually sold long term is still pricing in 75 to $80 oil. So it's the product market that causes these spikes that we could have seen in the 70s and 80s during shortages for gasoline, and those are crippling to the markets. But want to talk about what we're not abandoning also what isn't working. We're staying aligned to our core theses: international equities, energy, gold, infrastructure, resources like copper. They're not trades, they're positions built around long term trends. And environments like this don't change that, they test it. So I want to bring it all back. And maybe that brings us back to where we started. Just because, like the trip over spring break, there's a tendency to focus on stress points, the delays, the uncertainty, the things that don't go exactly as planned. But when you step back, those aren't the things that define experience. And markets are similar. There will always be volatility, there will always be uncertainty, but those moments don't define the long term outcome. What defines you is how you're positioned and how you respond. And in both investing and in life, consistency tends to matter more than reaction. So that was going to be a shorter commentary for you guys this month. Um, I didn't want to belabor a long note and get into the nitty gritty of earnings seasons, etc. We've hit a pocket of volatility. We've had an incredible run into the year. We're giving some back this month, and that's okay. We're very convicted and feel comfortable with positionings. And if you had any more questions or concerns, feel free to reach out to myself or any member of the team. Be safe and look forward to speaking with you all next month.